There was a flurry of interest earlier in the year on protection against inflation. So we had the INFL, and we had the IVOL,
right,
which bought, I think they buy tips.
They buy tips. They try to protect against the curve steepening. They're trying to protect against interest rates rising. Right. So it's sort of a multi-hedge strategy in IVOL. Right. A real darling.
But that was a flurry of interest in protecting against higher, all of a sudden, inflation.
Right. Inflation
in general.
Rates. Yeah.
Yeah. Now you recently unveiled two new hedge fund-like products, one to protect against interest rates, the other to protect against volatility. Explain the interest rate one.
Sure. So the interest rate strategy, ticker PFIX, is a brainchild of one of our managing partners, Harley Bassman, who actually is the father of the MOVE index. So he's been around the fixed income market and essentially allows access to ETF investors into the OTC derivatives market, specifically the swaptions market. That is the most liquid and the most sort of cost-efficient way of getting interest rate protection. And the key to this strategy is that it's essentially a concentrated call on yields. So if yields go up, if long-term yields go up over 7 years, so it's not picking the timing, it's saying over the next 7 years, if something makes interest rates go up, this strategy is positioned to do well and protect an overall portfolio.
And so you're designed to protect the overall portfolio, right? So you're owning long-dated put options, right, on 20-year treasuries.
Yep.
Well, that's simple to understand,
yes,
at least. And what about the volatility one? You've got the Simplified Volatility Premium. That's the other one. Explain how that works.
So ticker SVOL, we're essentially collecting a premium. If you look around the marketplace, how do you deliver yield or return or income in a very low yield environment? Certainly fixed income is struggling. Equities have low dividend yields now and are priced to perfection. One of the most attractive premia in our views that has yet to be tapped broadly is the volatility premium. And why is there a premium? There's a significant demand for insurance. So as everyone starts thinking about protecting their portfolio, they're buying things like puts, or also when they're buying calls to protect the upside or enhance their upside, it's creating a very steep VIX curve. And what this strategy does is collect the difference between two parts of that curve. Sounds complicated, but it essentially drives a lot of carry potential. And this strategy, the way it's constructed, has the potential to deliver in the tens of % of carry.
This is a complicated one.
Yes.
The other one, it's very easy to explain. You're owning put options on Treasury bond, 20-year Treasury. This is a little more, keep this full screen up. You're seeking a daily return of minus 0.2 to minus 0.3 on the S&P, so it's in inverse, right? You're flipping around.
Inverse
so if volatility, if the VIX is up 1%, you're going to be down 0.2,
yeah,
0.3% on the day. And at the same time, you're also buying futures contracts, putting call options to hedge against the moves in the VIX at the same time.
So the flip side to that risk you're taking of VIX going up, that curve is very steep. So if you're buying a month ahead, as your contract gets closer to the near month, you're actually clipping essentially a carry in that curve of 100%. 100% return where you 100% exposed to that. So we're 0.25, we're 25% exposure to 100% carry curve. We are able to deliver somewhere in the neighborhood of 20 to 25%.
So how would you, under what circumstances would this strategy really outperform?
Well, oddly, despite the fact that it sounds complex, what this really is an income vehicle, right? And with the bond market the way it is right now, nobody really wants to get 1.5 on the 10-year. It's just not attractive. Advisors are looking for any source of additional income they can, particularly for their older clients who are in retirement. Now, I'm not suggesting that this is for everybody who's headed into retirement, a widows and orphans type product, but we've seen a raft of these types of products that extract income from unlikely places because, frankly, there's nowhere else to get income.
So that's really what's going on. I think that's a great way to characterize this. It seems like some complicated strategy to protect you against something or to play into the volatility or the lack of volatility, but it's really just a way of trying to clip some additional income. But how risky is this versus, you know, the assuredness of having 1.3% on your 10-year?
Well, look, nothing's ever.
Under what circumstances is this really going to?
Nothing's ever going to be as low risk as buying an individual treasury and forgetting about it until it comes due, right? Until it matures. That is the lowest risk thing you can do. We know what you get for that right now. You get 1% and change on a 10-year lockup. So the question is, if you want more than that, what kind of risk are you willing to take? A lot of investors aren't willing to just take equity risk anymore, so they're looking for these strategies to pull that out. How risky is it? Well, it depends a little bit on what the equity markets do. The good news here is if the equity markets are frothy and volatile, it will do what it's supposed to do and generate a lot of income for you.
Right. So if all of a sudden, though, if the volatility goes up dramatically, you know, if the VIX goes from, pick a number, 16 or something to
40.
To 40 or something, what happens here? You're going to underperform. That S-vol is going to...
So our short VIX position would underperform, but we also have an overlay, again, of an option strategy where we're actually buying VIX calls, spending a little bit of money, a couple % a year, but that's enough of an overlay to significantly mitigate a lot of that sell-off. And if the VIX spike is steep enough, it could actually turn into a net gain in the overall strategy. So again, it's sort of trying to clip a carry, right, a coupon off a very attractive curve, but while playing some defense through the use of limits through options.